Two random dudes invest. Hey, I'm Danilo.
And I'm Brent.
And this is Two Random Dudes
Invest.
We are recording.
What are we recording?
We are recording, so you better not put this in the edit.
I was gonna put this in the
No,
edit.
you don't. All right.
What's up, investors? Another show with Brent right here, and I'm Danilo. And what are we talking about today?
Whoa. So today we're going to be talking about whether or not people are made to handle the volatility that can come with stocks and crypto and investing your money in things other than real estate. Because like with real estate, money goes up and, it goes up and down. The value of your house could be going up and down.
No.
For the last 10 years, it just seems like it's been going up for a lot of people.
No.
But if it were to go down, it goes down slower. You can't tell. You live in it anyways, and it's not as tangible. But in stocks, you can have losses. And how do you deal with those losses? How do you deal with the gains? Do you get super elated, and then when it's down, do you get super sad, and you sell your stocks when you shouldn't sell? So that's what we're going to talk about today.
Yeah, because the value of your house does not go down 20-30% the next day, tomorrow, and then back up 20% like some crypto stocks and crypto assets and others like speculative stocks. I think a lot of people one of the trends now is to get into speculative stocks. It's a lot of hype, frothiness. We call it frothiness in the space, and that's where it gets dangerous. When you hear a friend like, "Hey, did you hear about GME, AMC?" Like all these meme stocks are like kind of really, really dangerous. I know a friend that put in some money in this like GME, and some people don't even necessarily know what GME is, which is GameStop.
They basically just hear the story. They hear that it's going up, and then their emotions take over, and they put money in without even knowing like the backstory. Or maybe they understand it's a short squeeze, blah blah blah, and they put it in. But at the end of the day, I don't know what your mindset is, but for me, I'm trying to stay away from that kind of stuff because my goal is long term, and my goal is to I have principles set in place, and that is I don't chase high-flying things that are just have gone out of control. If I missed out on something, I don't get into it. Yeah. Another rule I have, which is this is totally on the other side, I don't buy IPOs until at least a few months to a year in. So IPOs are initial public offerings. It's when a company gets put into the market to raise funds. I got burned a long time ago, and the more and more I studied it and I looked at that industry, what happens is not industry, but in the stocks, when there's an IPO, more often than not, it might go up for a little bit, but at the end of the day, within a year, 2 years, the shares become unlocked. So a lot of people who have been in that company, maybe employees, the original owners, they end up selling a bit. So the stock can easily go down after that. Because a lot of the people who were in it beforehand, it's their time to cash in. So then, going on a tangent here that has nothing to do with volatility.
Well, so what does that have to do with can we handle it or not? It's just that volatility of the IPO, because sometimes it's fresh, it's about the hype. If you don't really know how these things work, and there's a lot of algorithms, you're kind of it's like what they say, the bulls can win, the bears can win, but the pigs get slaughtered. And that's just, pigs are investors that don't really have a plan.
They get greedy.
They get greedy. They just run with everybody else, like the sheep. To go back to your story, the story about a friend, when a friend asks, "Hey, are you getting into a GameStop, AMC?" He might be right to go into AMC at whatever price he got in for him. For it all depends on what time frame he's investing in. If he's investing into 5-10 year span, it might be a great idea because there is actually some fundamental reasons to invest into AMC or GameStop. I don't know it, but if I'm investing for 2-3 months and I need that cash in that time, it might not be a good time for me to listen to this person. So it's always good to listen, ask questions, but then make up our own mind from a place of knowledge and financial literacy.
No, that was good. I agree. I think that everyone is investing in the way that they invest, and someone might give you a hot tip on some stock, and they have the price that they got in at, and they have maybe they're good with their emotions, and you might not be, right?
Yeah.
And a lot of times, if you're hearing something from someone, it's usually too late.
Yeah.
But with these stocks, who knows? Like, again, don't listen to anybody out there, because they might go up, and you don't want to miss out. That's why whenever someone tells me that they're getting into this or not, I don't even say like be careful. I don't say you shouldn't get into that if I don't myself. I wouldn't get into it, because at the end of the day, you might tell them that, and then the stock could like double, triple, and they missed out on those gains. So I never want to be a part of that. So who knows? GameStop could keep on going up, and AMC could keep on going up. But the main thing this kind of episode is centering on is whether or not you can deal with these swings. So let's give an example here. Like, there are days where AMC or GameStop I think there was a day, I don't know, it was like 80%. I don't know how much it went up. At the end of the day, you see how much a stock went up or down that day. But that stock within that day could have had an intraday, like it could have gone up to like let's say a stock went from $50 to $100. And then in the same day, it may have come down 30%. So if you were that person who bought it at $100, like, you went down 30%, but it doesn't look like that. It just looks like the stock went up 20% that day. But you see what I'm getting at there?
Yeah, that little ticker that says +5 is sometimes misleading, because it doesn't tell you the whole story of how it
day.
went up and down.
And all the people holding the bags at the top in that scenario.
Yeah, exactly. To answer the question of the day, I think you had a good tool to mentally prepare yourself.
If you believe in certain things, like I believe in Bitcoin, and I do believe in Ethereum and some other cryptos, I'm willing to put my money into those stocks. Again, all my risk is kind of like allocated throughout all my stocks and crypto in a certain way. And in my mind, I understand that I am speculating. Like, that's speculation. But I'm always in things that if they go down, fundamentally, I still believe in them. And in some cases, you also have to have like an exit strategy of like, okay, if it's gone down this much, like, know when to fold them, right? Because even if you who knows what stock that is supposed to go up forever, just something changes, the CEO changes, or the fundamentals change. Always be on top of that. But the number one thing I did that's been helping me the last year is that with my with my crypto portfolio, which went up big time, I would literally visualize the losses, because I know that everyone keeps on saying this time is different. They were saying, oh my God, like maybe this is the time where Bitcoin will only go down 30%. And so in that case, I would mentally visualize my portfolio going down 30, 40%. But even more, I was visualizing my portfolio going down 60, 70%, because that is within the realm of Bitcoin and cryptocurrencies. It is within the realm of cryptocurrencies to go down 80% to then get that back and then go up another 10x, So the biggest thing is to get your mind ready. And then in stocks, as you know, like 90% of my portfolio are in things that I believe in, that are safer. Cryptos in the 5 to 10%, like things that are just kind of there, that are more speculative. But within stock too, I always imagine what can happen if it falls down a certain amount and how I'm going to react emotionally. So I do a lot of imagination. Like, I imagine how I will react to certain situations, and it's helped my emotions a lot during the downturns.
With that visualization, it's like, I don't know, I presume you feel, it's like getting that feeling, the emotion to play out the scenario before it happens, because the feeling is what gets you, right?
Yeah,
it's not like, oh, it went down, but it's like,
it's that in your gut.
It could be all sunny outside, but it just ruins your entire day. But it's like you visualize and you prepare yourself in advance. That's an excellent technique. And to add to that, basically stocks, for me, they're like a good tool to learn about my own emotions. So if I'm nervous at times about money, about investments, it's just going to amplify it. You're going to be super nervous. If you're calm, it's going to help you a lot. And if you're unsure about something, it's going to make you very unsure. When the thing goes up and down, it's like, okay, then I'm going to sell. It's just going to shake the cage. It's a good way for me to self-discover my own emotions and how I handle all this stimulus of the crazy swings up and down.
Yeah. No, and what I found over the last year is that the work that I've done with my emotions in investing have actually trickled into my life. So it's like I'm more calm in the markets. If there's a day where my portfolio is down, I've already planned it. I've already imagined it. So I look at, because I'm still building what is going to be a more passive investing style, but I'm still doing a lot of research. I'm still buying into stocks. I'm building positions in various stocks. And along the way, like I have a plan. I have cash on the side so that if there are down days, I have stocks that I want to buy. And so it's funny, but now when there's like down days and a stock's gone down huge that I really believe in, I get excited. But again, everything has to be, it's almost like a stoic, like I'm trying not to get too excited when things go up and I'm trying not to get too upset when things go down. And it's great. So as things go up, I'm keeping everything in check. And as things go down, so I don't try to live life like that though, right? Like in everything else, like when I dance and I really try to I want to really love the emotions of getting excited. But with investing, you really have to be a little more stoic. That's what I found with myself. Yeah. That being said, I don't think a lot of people are able to do this. And that's not a fault of their own. And again, I don't know what's going to happen when there's a big 40% cash or 50% cash. That crash, that's going to be the real test. But I do know that, I've gone through some 10, 20% corrections. And, in cryptocurrencies, I've gone through 30, 40, 50, 60, 70% corrections and kept my emotions in check. There was one more thing I had to say about people and emotions. I'm finding more and more that, and I always have to fight this, and a lot of people I think are the same way, is that they want to buy stocks when they're going strong, and a lot of people are getting into them. But the goal should be to get into the stocks when people are kind of getting out of it. If it's a good stock with fundamentals that you've done research on. Yeah. So I just want to give that point.
And we actually covered that in episode 2, I believe, of our podcast about FOMO.
FOMO, yeah. So you can check that out.
That and stop losses. That's let's get in the last one little minute because we disagree on this. One way to get the emotions out, especially for swing trading, which is more short-term, medium-term, holding stocks for like 2 weeks, a month, 2 months. For that, I believe stop losses could be a great tool, especially when used with technical analysis and buying at the right time it cuts you off when it doesn't do what you think it does, it cuts you off and then you're out and you don't have to make a emotional decision. Simple in theory, harder in practice. What's your take on this?
Okay, so my take on stop losses are that, okay, well, because I'm more long-term, for me, when I'm building a position in a stock that I believe in, my goal I'm not trying to time it, but I am. Like I'm trying to time it at a point where the stock might be going down a bit so that for me, it always helps me mentally when I get into something and it goes up, but that doesn't always happen, right? So you can be in a great stock and that stock can go down 10, 15, 20%. And so if I were to have a stop loss of, 5% or whatever, it can go down and then come back up and then you've missed out. And then mentally it's hard to get back in. So I know myself and I now, there's been many, many times where I will invest in something and it'll go down after I get it. No. And then it goes back up because I trust it and I've done my research into the fundamentals. Again, all speculation. So there's a chance, there's luck there as well. So that's why, but I think in your terms, maybe stop losses work, but I don't have a stop loss. I don't set stop losses that automatically trigger, but I do have like cutoff points. Like, okay, if I'm in something and I put a certain amount in, I'm like, okay, if I lose 30%, or it's gone down 35%, or in some cases 20, depending on the stock and how much I trust in it and how much risk I have in, I do have points where I will sell. I think
we re-emphasize
everything again and again.
Have a plan. That's like number one. Like it's just understanding, get that financial literacy, understanding why we do things, questioning things, and learning about it. We like it. That's what we share.
Yeah. Oh, and another thing really important before we go is something that really helps me with this visualization in my portfolio, and I want to talk about it in our next podcast, is my version of risk management. So that's like how I am managing my risk in a way that helps me mentally feel better about when things go down. Because what happens is like if one of my stocks goes down even 100%, it's not going to affect my portfolio to an extent that I can't live my life normally. If one sector goes down, if an entire sector that I've invested in goes to zero, I'm still okay. And so I want to have a whole episode where I kind of just break down my new strategy. It's not new, but it's actually something I've been working on for the last 10 years.
Yeah.
And actually, Michael O'Leary has a very similar allocation strategy. And luckily, it turned out that I have the same one, kind of. So
Yeah, but each person should make their own strategy, and like it's good to learn from different people. But it's good.
Oh, Kevin O'Leary.
Kevin O'Leary.
I said Michael O'Leary. Kevin O'Leary.
Yeah, but like some people like him, some people hate him. But like bada bing, bada boom. But it's good to have your own plan and formulating your own opinions, asking the questions, asking the hard questions, and making your own game plan. And I think it's great that you're like diversifying, and that's one thing I'm working on. So I'm more into EVs, and that's what I know. Because I've been burnt when I trade stuff that I don't know. I'm like, I'm gonna trade back here. So
Cool.
It's a very good thing that you're doing, and we're gonna
Wrap it up.
hit it up in another following exciting episode. If you had any value from this, just let us down in the comments. Follow us on Instagram and
No music, and I'm dancing.
Brent Callis, Vanilla Volvic, and we'll talk to you soon.
Thank you. Peace. Thank you.
If you're on the go, you could check out our podcast, link in the description.